guided more from the systemic risk center at the London School of Economics, and it's on the cross-section of tail risks and stock returns. Thank you.
And thank you, Nikos, as well, for the invitation. I'm happy to be here. My presentation is going to be slightly different than what we're used to so far. We've been talking a lot about systemic risk measures, how to measure it, where are some problems with it, where we should be looking. Most of these papers have dealt, obviously, with time series as we're trying to predict or we're trying to gauge what the risk is in the system as we move along. This is, by the title, you can see I'm going to be looking at a cross-section of tail risk. So it's also not a multivariate setup in any sort of sense. Basically, our starting assumption is what we're going to... Well,
maybe full screen, maybe share it and support.
This is here.
There we go. So when I talk about tail risk, I'm going to have to be a little bit more precise here. And our starting assumption is going to move away from a Gaussian setup, from a normal distribution, and we're going to look at heavy tails. Now, why would I come and give a talk like this at a measuring systemic risk conference? Hopefully I can convince you that there's some sort of systemic risk inherent in here. Not directly, but indirectly we can start to think about it. One problem, of course, that was leading up to a crisis, or even previous to that, is that there was a tendency to model things using normal distribution because of its simplicity and because of its tractability. It was easy to understand. And a lot of the critique that we have with moving to a heavy tail setup is that, how do we model this? It becomes quite difficult to manage, and therefore, there's some sort of a tendency to stick with modeling normal distribution, to model certain systems using a normal distribution. And I will argue here in this paper, and hopefully I can convince you, is that under certain assumptions that I will show throughout the paper, that it's actually not so difficult if we look at a heavy tail setup, and perhaps we can start looking at tail risks in this way and apply similar methodologies without having this obvious error in our assumption when we look at asset returns. So instead of looking at the whole distribution like we would with under a normal Gaussian setup, we're only obviously going to look at the tail here. And the difference between this is that we have a power law decay versus exponential power law when we look at the heavy tail. And so when we look at this, when we look at the downside risk, or when we look at the left tail in this sense, we will see that the downside risk is going to be characterized by two parameters: a scaling factor and a tail index factor. So the alpha and the capital A, which I'll refer to as tail index and tail scale for the rest of the paper. And from this first order approximation that we have here, and and this is an approximation, we could, by Taylor's expansion, we could have further orders of precision. But as a starting point, as a first order approximation, we could also approximate a downside tail risk measure, such as a value at risk by a transformation of the above equation. So in the cross-section here for a downside risk measure, as opposed to the Gaussian setup, we now have two parameters. We have a downside tail risk that could come in form of the tail index, come from the tail index or from the tail scale. And this is what I was talking about when I started off, that we have this added complexity when we want to look at downside tail risk when we look at heavy tails. Now, it's not as much. It's not as enough just to look at the downside tail risks when we look at. When we look at the heavy tails, just to say simply that they are heavy. When we look at the tails in the Gaussian, they are the same. They follow the same exponential decay. But when we look at the heavy tails, now we have to gauge. Well, what is this tail index? How heavy is heavy? Are all the asset returns that we look at, do they have the same degree of decay in the tail, or is there some sort of differentiation? And so this is the first question of the paper: are the tail characteristics different in the cross section? And just as a starting point, we say, well, why should they be? Or why should they be the same, or why they should be different? So a low tail index or a high tail scale will simply just lead to a higher tail risk. And from this higher or lower tail risk, we might be able to find a risk expected return trade-off. And as long as this high tail risk is being able to be compensated by high expected return, well, then we can say stock returns can be however the downside risk can be as high or low as we want. The tail thickness can be as thick or thin as we want. So mathematically, this is possible. And what makes it tricky is that the tail properties are not directly associated to the mean. This is exactly the feature that is missed when we look at downside tail risk from a semi-parametric model. So we only look at the tail, therefore we don't care about the whole distribution. Therefore, these two ideas, this idea of the mean and the idea of the downside tail risk, are somehow disjoint from one another. Now, our surprising answer from this paper, our answer from this paper is that for the tail index, we find that no, under certain assumptions, differences in the tail index simply cannot be priced. And this would suggest to us that the tail index is homogeneous in the cross-section across assets. And for the tail scale, yes, differences in the tail scale can be fairly priced. Now, I also, if anybody has any questions as I go along, I strongly suggest you just interrupt me. I mean, it would be worse to continue and lose everybody. So,
sorry, can you tell me what the difference between the tail scale and tail indexes?
Yeah, so from the equation on the top, right here. So we have these two parameters that we want to look at when we're talking about the downside tail risk. And so basically what we're going to argue, what I'm going to argue in this paper, is that this tail index right here will be cross-sectionally homogeneous. And then all the differences in downside tail risk will come from differences on the tail scale. Okay. Now, why is this going to be a nice feature, and why should we care about this? Is because we've reduced an equation that has two parameters down to one. When we're looking at risks in mean variance framework, what's tractable about this is that it's simply that. We look at the mean and we look at the variance. We have a two-parameter system. Here, if we had a three-parameter system, then it would become quite difficult to have some sort of a pricing framework. And by simplification, by getting rid of the differences in the tail index, and by only looking at the tail scale, then we can reduce this looking at downside tail risk from a heavy tail framework down to one that is analogous to a mean variance framework. Yeah.
So in a simple histogram, how we will define the tail index and the tail scale? So in the previous slide that you had,
Sorry?
in the previous one, yeah, how can you define here the tail index and the tail scale?
Okay, well, the way you think about it, to define it, but if you think about it, is that the tail index is how heavy the tail is. So, how thick it becomes in the tail.
Yeah.
So the higher the tail index, the thinner the tail. So as alpha approaches infinity, then we get to the exponential decay of the tail. And as the tail index approaches, and then for a decrease in the tail index down to 1, then we will get a thicker and thicker tail. If the tail index goes lower than 1, which I will have this condition that it cannot, then the tail will be so thick that the mean will not exist.
That's good.
So we can think of it like this. Another way to think about it, which is might be more familiar with many people, is that if we have a student t distribution, then the degree of freedom of the student t distribution maps directly to the tail index. So a student t distribution of degree 3 makes will have a tail thickness of 3 here. Yeah, sure.
What percentage of your sample size has characterized by the right-hand type distribution?
I'm sorry?
What percentage of your sample? Because you
Well, I don't have a sample yet. So that's what.
so you haven't empirically tested.
Not quite yet. I mean, in the paper I will, but first I want to. So this is what I was going to get to now. I mean, so this paper is quite long, and and it's the first time I've presented it in its entirety. So I have a theoretical section and I have an empirical section of the paper. Originally, this was 2 separate papers. We decided to put it together because they went together so nicely. So at the beginning, I'm going to go through a theory of why this would exist, and then hopefully, if I have time, I can briefly touch upon the empirics that we have. And so when we get to there, we can talk about that. So the theory comes in 2 separate parts, and under certain conditions, I'm going to show this homogeneous tail index, and I'll call this a tail index equivalence hypothesis under certain assumptions. And I will show this heterogeneity in the scale parameter, which will in turn be able to price the downside risk. After that, if I have time, some empirics, and we'll watch the time to see how fast I can get through this. I mean, this is somehow the good and the bad thing about being between people, group of people and lunch. I mean, people are not going to ask me too many difficult questions. But no, please do. So, okay, first I have to motivate this because in the literature, this tail index equivalence or homogeneity is often assumed in theoretical literature. So from Fabat, he was using the stable distribution, and he assumed that the characteristic parameter on the stable distribution, which maps to the tail index, is constant. From that, he takes the scaling parameter from the stable distribution, and then he's able to price downside risk. That was in 65. Bawa does something similar in 1979. Hein and Debris, 2002, used a Pareto type distribution. They assume a constant tail index. Then they use the scale to price downside risk. This again happens in Ibrahimov and Walden and Joe in 2010. So people have been using this assumption, but so far in the literature, there's been no attempt at a theoretical justification for why this might be. At least to the best of my knowledge, this will be a first attempt at that. And it's empirically, even for the second part of the paper, it's rarely been tested. There's weak evidence from various papers that have estimated the tail index that it's somehow between 3 and 4 for equity returns. This is just an observation. And then there's been simple tests to show that these are homogeneous in the cross-section. One is by Janssen and De Vries. They assume cross-sectional independence, and they also have to pre-assume that there exists a tail index, and so they do, I'll get to it later, but they don't, their test is a tail index of one asset equal to the tail index of another asset, but rather is a tail index equal to some arbitrarily chosen index, and then they go through the assets one by one to compare it to a hypothetical tail index. And then Jean-Louis and Rockinger do the exact same thing, except they allow for serial dependence in their test, so time series dependence. What we're going to do here is we're going to apply what we believe is a stronger test and allow, we're going to relax assumption of independence cross-sectionally, and our test is going to allow for dependence. And we will use this theory to support this empirical test to support our theoretical argument. Any questions so far? Okay, so the framework, the assumption that we're going to use in this theoretical exercise is that we're going to assume a generalized lexicographical form of the safety first utility, first introduced by Pelser in 55. So basically, we first constrain the probability of investor having large losses. Only when that constraint is satisfied, then the investor cares to maximize expected return. This was mathematically Arsak and Valva. We're going to, in 77, present a distribution free model for this setup that we're going to follow almost entirely, except we're going to impose the heavy tail assumption here. And by taking these assumptions and the framework of Arsak and Valva, we will be able to show this tail index equivalence and then be able to price the scale in the end. So, okay, it's a basic setup here where an investor has a certain wealth at period 1. He has a choice to invest in a portfolio of assets or on a risk-free asset that will pay off in the next period. Then his first consideration is that his loss on wealth does not exceed some maximum amount. And he does, and this concern is weighted with some sort of probability P. If he satisfies this constraint, then only after that will he try to find maximum returns of the portfolio. Okay? Why take this utility? I mean, safety first investors will care foremost about downside tail risk, and that's what we're looking at. And in the paper by Arzak Bawa, they show that under these assumptions, you can price downside, you can price risk in the same framework as the mean variance. So and Campbell 2001 shows the same result. So we don't lose too much with this assumption.
Kai,
Yeah.
I have a question.
Yeah.
You were talking about tail risk, but you also have volatility, it's a risk factor going on. So my understanding is that the tail scale will play the role of the volatility.
Okay, when we go to this,
The alpha will play the
sorry.
role of the tail risk. So my question is, if I understand risk as a combination of tail risk and volatility, how does it fit in this utility function?
This is a perfect question. I'm glad you asked it because maybe I'm going a bit too fast. So under this utility function, we move from a mean variance type framework to an Arzak Bawa show we move to a mean bar type framework. So we're balancing this value at risk constraint against the expected return rather than the variance on the risk. So the risk in under a Gaussian distribution will be exactly that, the variance. Here it will be the value at risk. So when we go back to this characterization of the bar from our heavy-tailed assumption, then in fact the risk is both the tail index and the scale. But of course the tail index is first order that dominates the scale here. So, but the risk is in fact both of them. How you want to compare that with a variance, this is in analogy, I guess, only when we move from the mean variance framework to this let's go graphical safety first.
Then we
Yeah.
can understand the tail scale as the volatility, not being a variance, not being a moment, just being a parameter that tells you about dispersion.
Yeah, exactly. Yeah, exactly. This is one way to think about it. Yes. So from this equation, we can transform our setup to, instead of work with prices, we work with returns. So we will produce two new parameters stated here, which will just be the fraction invested in the risk-free rate. This can be we allow borrowing or lending. So if this is if theta goes negative, we will just simply think of this as a leverage ratio. And the threshold we just transform from a level to a price level to a return here. And so therefore our probability constraint is written out in terms of loading on returns on the portfolio or on the risk-free asset. And our utility maximization becomes equivalent to this right here. So to maximize expected returns subject to this downside risk. So just to rate returns a more convenient setup. So the intuition for our theory stemming from this is that of course we know that there's more than two assets in a portfolio, but we will start with two and then we will show that, it can easily be shown that we can extend this to an asset. So we consider two assets with expected returns both greater than the risk-free rate, and with tail indices alpha 1 and alpha 2 that are unequal, where alpha 1, where the first asset has a heavier tail distribution than the second asset, and both assets have a tail index greater than 1. That's necessary, so we have the existence of the mean. So, another way to think of the tail index is existence of moments. If alpha is less than 2, then the variance doesn't exist. But in terms of for instance, but in terms for our demonstration, we just only needed greater than 1. The intuition is that we will do a simple comparison of the two downside risks here of both asset 1 and asset 2, and we show that for the heavier tailed asset, it dominates it asymptotically, such that the tail risks can be seen as an incomparable level. So to satisfy the probability constraint on both assets with different tail indices, one has to load completely on load incomparably on asset 1, and by doing so, it cannot be compensated in the finite level of expected returns. What I mean is that if an investor chooses to hold asset 1, the tail risk will be so much greater than asset 2 that no amount of expected return from asset 1 will compensate for that asymptotically as P goes to 0. And so therefore, asset 2 is strictly favored by a safety first investor as the probability constraint goes to 0. Sorry, yeah.
Coming back to my previous question, that also depends on the scale index.
No, it doesn't. Here it doesn't. The scale is dominated by the tail index, and so the scale plays no role.
But if one scale is much bigger than the other,
Asymptotically, it won't matter. I will get to that after. That will come into play afterwards, but as the probability goes to 0, then the tail index strictly dominates the scale, and so the scale will play no role. Yeah, but this is exactly the reason why I will show later why you cannot compensate for an expected return. Only if that's true, that you can compensate it for in scale, then you can have a differentiation in the tail index, but I'll get to that in a second. And then if the investor chooses to hold a portfolio of asset 1 and asset 2, the heavier tail dominates the portfolio tail risk always. This is a result by Joe, 2010. So if I load epsilon on asset 1, then the tail risk will be strictly characterized by asset 1, and therefore no amount of holding asset 2 will be able to compensate for this. So again, we're back at the same result that the investor will choose omega 1 equal to 0, omega 2 equal to 1, and SB goes to 0. And so we'll have the same result that an investor will only choose to hold asset 2. Okay? So this leads us to our first theorem that for any given omega of a portfolio between two assets, there exists a positive probability level, P star, such that if P is lower than P star, then the maximum utility associated to the strategy of holding a portfolio on two assets is lower than the associated investment strategy of holding asset 2. Therefore, we only want to hold asset 2 as long as the probability is sufficiently low. And the reason for this is that this, briefly how to solve it, is that this amount of loading, borrowing on the risk-free rate is a decreasing function of both the expected return and of the probability constraint. So we simply have to lower the theta enough to satisfy the probability constraint, and at the same time that will be maximizing the expected return of the portfolio. So we can have a theta here equal to theta omega for any given omega. It will give us this result on the expected return, and then we simply have to verify this relation that as P goes to 0, the expected return of holding the portfolio versus only holding asset 2 cannot be compensated. So holding asset 2 is strictly dominated than holding any portfolio. So the direct implication of this is that the heavier tailed asset will never be traded in the market, not even as part of a portfolio. So this is an existence type of argument. We can obviously extend this to a multi-asset market where only the assets with the thinnest tail or the highest tail index will be traded, and therefore all assets in that market will share the same tail index. We call this tail index equivalent hypothesis in the paper. So of course, there's some downside to this setup, and that is that this tail index equivalence hypothesis is a really strong hypothesis, and the reason I say so is because we need this probability asymptotically to go to zero. Clearly, this is not something that is realistic in markets. That investors do have downside tail risk, but certainly not infinitely so. This is due to the fact that we're only looking at a first order approximation. So we lose a lot of information on the Pareto type distribution of the tail. And so I will show that we can relax this assumption of asymptotics, and I can show that there's a finite probability level for which investors will only choose to hold the thinnest tailed assets, but not necessarily one that has to be going to zero or asymptotic, an asymptotic result. So in order to relax this, we have to look at a second order approximation of the tail, and where the first part right here is our exact same tail index and tail scale that we were looking at originally, and now we have a second order scale and a second order tail index on each asset. The only downside when we move to this one is it becomes untrackable to look at the dependence across the assets. I failed to mention this before, but when we are looking at this portfolio setup here, that this result of the heavier tailed asset being dominating the downside tail risk of the thinner tailed asset is consistent under independence or dependence. But when we move to this to the second order tail approximation, there's no result for dependence, and so we don't have that result right now. We have to move back theoretically to the assumption that the assets traded are cross-sectionally independent. So this proof in the paper is quite is a lot more rigorous, and there's no way for me to go through it with any sort of length of time. I will simply say that there exists some positive probability P star, which is greater than zero, such that if the tail indices between the two assets, R1 and R2, returns on assets 1 and 2, are sufficiently close, depending on this relationship, and if the second order tail scale is negative, then a safety first investor with this admissible probability below P star will only invest in asset 2 and the risk-free asset. Now, this result right here, that they have to be sufficiently close, is slightly problematic, but perhaps not economically so. That if the tail indices are sufficiently close together anyway, then empirically we won't see much difference in the downside tail risk. This one right here is a little bit more esoteric, but thankfully this parameter in most distributions that we use to analyze assets, a stable distribution, the student T distribution, they all share this property that the second order tail scale is negative. So it's consistent with most ways of viewing asset prices, or asset returns, sorry. So the implication here is that the tail index hypothesis may hold or may not hold. And when it fails is when we have the second order tail scale greater than zero, and it's unlikely, as I just described, or if the two indices are close, are not close, which may not imply any sort of economic difference. And the last way is that if the downside tail risk of safety first investors is not low enough, and this is the interesting part, I would say, is that under conditions where investors seem to have less downside risk concern, possibly during some sort of an economic boom time, then we might be able to see it difficult to price the downside risk of assets owing to this potential difference in the tail index. So just to compare between these two theorems, one with first order and one with second order approximation, is that the weak condition where it might exist is the weak condition where we need the probability to go to 0. Asset returns can be dependent, and the strong conclusion there is that the heavier tails are not traded. And when we go to the second order, we just describe the ways in which that might not be true. So since I've gone through the tail index, and David was mentioning before about, okay, well, how about the scale? Maybe the scale could somehow compensate for this. So the next obvious question to ask is there a scale? Is there heterogeneity or homogeneity within the scale parameter? And so we test the same ratio here of the downside risk in asset 1 and asset 2, and we see if the same result will hold, that asymptotically we won't be able to price the risks. We don't find that. We find that differences in the scale can be compensated for in expected return if we allow the tail index to be homogeneous. How much time do I have? I didn't see how much time.
2 minutes.
10 minutes?
Yeah.
Okay. Let me see here. Okay. So what we show in the paper that indeed this tail scale can be heterogeneous. Therefore, the downside risk across assets is heterogeneous, but only in the tail scale. We show that once you have that, then we can go back to the results in the Arzat-Bawa paper that the expected return, the expected return given our safety first assumption of utility will be characterized by this relation, where we have a beta that will price each asset, and this beta is consistent with the same beta found in Arzat-Bawa, except where they use distribution free, their setup is distribution free. We show explicitly what the formula on beta should be, and that's determined by the tail scale of each asset, which in turn is determined by the characteristics of that asset. Therefore, we can get back to a similar setup where we have an optimal portfolio, which is determined by the relative downside risk of each asset, and the amount of loading on that asset will be determined solely by the wealth of the investor. So we have something like a market portfolio that will be that we can construct, that investors will simply load on, depending on their preferences. So the summary of the theory is that we have a theoretical justification on the tail index equivalence, and it's a strong conclusion to the limit, weak conclusion, but at a positive admissible probability. And we have a theoretical justification on the heterogeneity of the tail scale, and so from that we can establish an equilibrium price based on scale and dependence. Finite level differences in expected return may be compensated difference in the scales, but cannot be compensated that in the tail indices if investors have concerns on extreme tail risks. Now, if I have 5 minutes left, then I'll go extremely quickly for proof.
Sorry,
yeah.
I have another question on the beta that
Yeah.
you mentioned 2 slides ago.
Yeah, please, yeah.
So in the traditional setting, this beta is a linear projection, or is a result of a
Could you repeat that? I just
In
can't
the
quite hear.
traditional setting, this beta is a linear projection, so it's variance divided by the product of the standard deviation. But in your setting, on the top of that, you have the tail aspects. Yeah, you mentioned before that this beta depends on the tail index, but it also depends on the covariance. So my question is it possible to disentangle these two effects, the linear effect of the beta, which is the covariance, and the non-linear effect of the beta, which is given by the tail index?
So my point is that from this, and maybe it's not completely clear, is that if the downside risk measure, which is the value at risk, can be collapsed into only the scale, then you can forget about the the thickness of the tail, or the tail index. And all of the risk gets collapsed into the scale. Okay? And so therefore, it's a linear projection of the scale only, with, onto the expected return, which will give you the beta. But the tail index does not play a direct role, but only indirectly in the downside risk because it's constant across assets. Does that make sense? Or are you unconvinced?
We can continue.
Yeah. Okay, so since I only have a couple of seconds left now, we simply show in the paper there's a way to model, this way to model downside tail dependence of assets. This is given, and then we show this joint asymptotic property of the estimates. The tail index estimates can be characterized by this by normal distribution of mean zero and variance covariance matrix characterized by this function. Okay, we show that in detail in the paper, and for our data, since it was asked at the beginning, we applied this to 230 non-U.S. financial firms traded throughout a period between 2000 to 2011. One difficulty in estimating this tail index is that it requires a large amount of data, namely about 4 years. So we do a 4-year rolling window on this data, and we take market returns from the S&P 500. And by our setups, by our setup, which is detailed in the paper, we show that we reject the tail index equivalents from the years 2000 to 2007, roughly 2006, 2007, and then after 2007 till 2011, we cannot reject. We fail to reject the tail index equivalents. So therefore, during these periods where people seem to care more about downside risk concerns, the tail index equivalence seems to hold, whereas in the period predating it, during this more economic boom time, then we fail to show it. Using a similar test on the scales, we reject the tail scales are the same in every period. So those are our basic results, and I'm sorry that I couldn't get through it all, but it's an extremely long paper.
Okay, thank you. Questions?
Your theoretical construction is based heavily on the assumption that X is going to minus infinity. Right?
Yeah.
So in your empirical part, what is the worst percentage return we have, value-wise? Because I struggle to figure out, what does it mean the percentage return to go to minus infinity?
I understand this concern. I'll answer it another way if I can. Is that the tail, when we look at this Pareto type tail at first order approximation, is that the property it has is that it's scale invariant. Okay? So when we estimate the tail, it's not necessary to go to the deepest part of the tail to go to take X to go to infinity or minus infinity. And this is the nice property of analyzing it, is that we simply have to be able to determine where that tail starts, and then after that we can extrapolate out the tail based on this scale invariance. Okay? So the tricky part is actually determining where the tail starts empirically. So where we can start to analyze this scale invariance. Now, it doesn't matter in the data set necessarily, as long as this estimation is done correctly, if we have X to go to infinity or not. But we can determine the probability of it going to very, very large or very, very negative numbers without actually observing them in the data set. And this extrapolation feature that we're able to take from this scale invariance is the really nice feature of analyzing stuff using extreme value theory, which I didn't fully describe, but this is the methodology behind it.
And if we're going to go to minus infinity, then the question is how large is large? If I have a natural boundary for negative returns, which you do in your examples, it's just a theoretical extrapolation but the data will not fit with your basic assumptions of the theory. Because you cannot go beyond minus 100%, no matter how much you start.
No, but this is if you assume, I mean, we use log returns, so I can go, so there's no boundary. In the empirical setup, then log
So
returns.
you have minus 300% in your data?
Well, you theoretically could. Yeah, there's no boundary on it. I mean, I can't remember what is the most negative number that we have from the data set. But it's unbounded negative or positive if you choose to use some. This is the problem. I mean, if you use as you suggest returns in this way, then yeah, okay. This is a strange question. Not your question. I mean, it's a difficult question to disentangle these two ideas. One you have a bounded returns, and one where you allow returns to be unbounded.
Or some data break.
Sure.
Okay, so thank you.